And action, and please no talking during the presentations, and show everybody show them your support.
Alright, 9.5, present value of dividends. So Fresno Corporation Management expects to grow at a 30% growth rate over the next 2 years, and then 18% for the 3 years after that. The last dividend they paid was $2.15, and the question wants you to estimate the dividends paid for the next 5 years. Keep them at a 14% required rate of return. So to find the dividend paid after year 1, you take D0, which is just $2.15. This is the first dividend paid, and you multiply that by 1 plus the growth rate. The growth rate is 30%, so 1 plus that is 1.3. Multiply those two together, you get $2 and about 80 cents for year 1. And then you take that and you plug it in to find the second year. So now it becomes that same $2 and about 79 cents multiplied by the same 1.3 for the growth rate, because it's still 30% this year, and that gives you about $3.60-something. So then for the third year, you do the same thing, except for the question mentions that the rate is going to drop down to 18%. So instead of that 1 plus 3, 1 plus 0.3, you do 1 plus 0.18. So that gives you 1.18 times that $3.60-something over there, and then that gives you about $4.30, and then you plug that in for year 4, and you do the same for year 5. Question 9.6 talks about some corporation that paid a dividend of $4.18 last year. It says management doesn't expect to increase the dividend in the near future, and the required return rate is 18.5%, and it wants you to find the stock's current value. So you start with your starting dividend paid at $4.18. Your growth is 0, and your return is required return rate is 18.5%. So you take the starting dividend and you divide it by the required return of 18.5%, and you get $22.60 for the stock's current value.
So for 9.32, the bank pays your annual dividend for $4.27, and then your required rate of return is going to be 12.2%. And then for question A is going to be asking for the value of the stock. So given that the dividend is $4.27, and then the required rate of return is 12.2%, you're going to plug it into the equation for finding out the value of the stock. It's going to be dividend over required rate of return, and then 4.27 over 0.12, which will give you $35 for your stock. And then the second part of the question asks if you should still buy the stock if it's $34.41. And since the stock is worth $35, yes, you should buy it. Because if you're going to be buying at a lower price, if you buy it at 34.41. And now to the second part of the question, 9.33. The stock market price for the stock is going to be $36.34. And the dividends expected is to grow at a rate of 6%, which is constant. And then the last dividend was $3.25. And the required rate of return is going to be 16%. So the first part of the question asks, what is the value of the stock? And you're going to use the equation D1 over R over minus G. And then that's going to give you, to plug in 3.25 times 1.06. And then that's going to be over 0.16 minus 0.06. And then that'll give you $34.45. And the second part of the question is going to ask you if you should buy more shares. And no, you should not, because the stock is overpriced. It's selling for more than it's worth. So you should be selling your own shares.
under 8.12. Above this dotted line is all the given information, so they give you the purchase price, year the investment's held, the coupon rate, frequency of payment, annual coupon rate, and then, so to solve this, you're going to use the trial and error method to try to compute the realized return and the exact yield rate. So you just start like plugging in different interest rates that you think is going to work out. The closest one that I got to is 9.5% interest rate. So then you use this equation right here and just start plugging in all the given information with that interest rate that you came up with. It all comes out, and then 9.5 actually came out to about 45 cents exactly less than what you wanted. So then you use the financial calculator, plug in your N, PMT, present value and future value, and then you get the exact yield rate, which is 9.52%.
You're ready to do oil.
Basically, we said this is a bit of information. The company expected growth rate is 23% for the next 4 years, and then expected growth rate at a constant rate of 6%. And then this is the first dividend, 4.25, and then this is the required rate of 17%. So you're going to get T4, it's T3 times 1.23, which equals 4.5, times 423, which equals 5.3. And then your T4 is D5 over R minus G, which is 523 times 106 over 0.07 minus 0.06, which equals $50.36. And then you're going to go D1 over 1 plus R plus D2 over 1 plus R squared plus D3 over 1 plus R cubed plus D3 plus P4 over 1 plus R whole power, and then just plug all those in. And after you do all that work, I didn't write the answer actually. The answer is actually going to be $32.33 after you plug all those into that formula.
Mine was 9.26. This was asking what is the stock price for today for a company that expects to pay no dividends within the next 6 years. So we'll take the growth rate, and then we will take the dividends, and then we will times 3.25, add 3.25 plus the 96 over 1.24 is the power, and then we get stock value of $4.79.
But you're trying to figure out the current value of the stock. So it gives you the quarter dividend of the preferred stock and the required rate of return. And you put it into this equation of the quarter dividend preferred stock, which is $1.80, but you can multiply it by 4 by the quarterly rate, and then divide it by 0.08, which is the required rate of return, which is a given. So you do that equation, and then you get $90 of the current value of the stock.
My problem's 9.8, and you're basically finding the stock that the value of $25 is overpriced, underpriced, or correct future price. So to get this, we need the equation of the constant growth model, which is the recently paid dividend times 1 plus the growth rate over required rate of return minus growth rate. So this these values were all given. So recently paid dividend is 2.25. Required rate of return is 14%. Growth rate is 5%. So once you put it all in the equation, you'll get $26.25, which means that the stock was underpriced and it's a good buy.
Alright, so I have a problem with 8.28 part A, and the question is asking for the yield to maturity of these bonds. And it's saying that this company has 7 years of bonds outstanding and they pay 8.375% interest rate. And they're currently worth 1,063. So to do that, all the numbers are given. All you have to do is plug in the numbers into this formula with the 8.375 rate, and then over here you're gonna do the same thing with the same formula, just use a lower rate, and then their yield to maturity rate would be 7.2%.
I had 8.26, hopefully it's not too hard to read down here. But, so it's about a corporation that issued 10-year bonds 4 years ago with a coupon rate of 9.375%. At the time of issue, the bond sold at par. Today, bonds with equivalent risk and maturity must pay an annual coupon of 6.25% to sell at par value. And we're supposed to assume 7 annual coupon payments. So our question is, what will the current market price of the firm's bonds? So all of our given values, so the years of maturity is 6, which is represented as the inflation. And the payment frequency is every 2 years. Yeah. And then the coupon rate 9.75, semi-annual, is calculated to be $46. Yeah, $46. And then the current market rate is 6.25%. So we have to plug it into this equation here, which I wrote down. So when you plug the numbers, ultimately you get $1,154 and 38 cents. And that is the current market price of the firm's bonds after 10 years.
Okay, so the 8.22 units of maturity, Avery Industries plans to buy a 10-year coupon bonds issued by the U.S. Treasury. If these bonds have a face value of $1,000 and are currently selling at $404.59, what is the expected return on them? Assume that interest compounds semi-annually on similar paying bonds. So first we we organize all the variables together, present value is $404.69. Years to maturity is 10 years. Frequency of payment is 2. Coupon rate 0%. And current market rate will just be I. So for the years to maturity, we use a trial and error approach. So we first use 10% and plug it into the equation, which gives us 376.89, which is not equal to 24.59, and equal until we get down to 9.25%, which we get a value close to 4.59, which is 24.85. And then we look for the expected return, which we plug into the equation 1 plus quarter grade to then power minus 1, and then we get 4.6%.
So I did 9.18, this is about constant growth. K. Williams is interested in purchasing common stock, which is currently priced at $37.45. Company is expected to pay $2.50 next year, and to increase its dividend at a constant rate of 7%. So the first question is, what should the market value of the stock be if the required rate of return is 14%? So this is the equation. Plug in the dividend on top, and then it's asking at 14%, so plug that in and subtract the constant rate, and you're going to get it's a good buy, whatever you want, is the stock price is overpriced and not a good buy. And then for 9.19, similar question, so we have R is 23%, D is $1.2, $3.04, G is 5%. We're gonna plug this into this equation to find the expected price of the stock 3 years from now. And with that, we get $21.80.
Sounds good, thank you.
So who's over there?
Okay, so this is 8.16 to find out if you paid the right price for a bond. What's given is that the outstanding bond will mature in 6 years and will pay 8% annually. You're gonna pay $1,036.65 today for the bond, and with a required return of 6.6%. So to find out if you paid the right price or not, these are the given values that you need to find. Years to maturity, which is 6, frequency of payment, which is 2, coupon rate is 8%. Semi-annual coupon is the $1,000 times 8% divided by 2, which equals $40. Your current market rate, which is 6.6%, and you're trying to find the present value of the bond. So this is the formula to find it. When you plug in the numbers, you can also do it on a financial calculator by plugging in N, interest percent, present, forget this one, present value bond, and future value. When you plug in these numbers, you get 1,068.45, showing you that you paid less than the bond was worth, making it a good buy.
I had 7.31, which is Linda, an old lady, needs portfolio to have an expected return of 12%. And she's decided to invest in 3 different stocks. Stock 1, she's invested 25% of her assets. Stock 2, she invested 50%, and stock 3 is 25%. And stock 1 has a 9% return, stock 2 has a 10% return. So she's trying to find out what stock 3 needs to return in order to get that 12% return. So you use this equation, which is basically the percent of her assets that are in it times the actual return plus the average insurance income. Plug them all in, and then we find out that 3 needs 19% of the return. And then I also had 7.1, which is the APM. And so it's Capstone Corporation, and they're trying to find out what their stock could be traded at in 1 year, when the risk-free rate is 3% and the market risk premium is 8%, and then their beta is 0.65. Their current stock was $64.61, and they pay an annual dividend of $1.92. So first you have to find, use the CAPM to find value. So you use the risk-free rate plus their beta, and multiply the beta by basically the market risk. And so you find that that comes out to equaling 0.82. And then you plug it into this formula to find the price a year from now. And then the price is now $67.99.
you're cool.
So the question is, you're considering investing in a 10-year zero coupon bond that compounds interest semi-annually, and the current market rate is 5.65%, and what's the maximum price you should have to pay for the bond? So you use the present value equation, and then you just plug in all these givens, and then you solve through, and then it gives you 572.82, and that's the maximum price you should have to pay.
Based off of what
Alright. So, 9.2, Merriweather Manufacturing Company has been growing at a rate of 6% for the past 2 years, and the CEO expects the company to continue to grow at this rate for the next several years. So, the company paid a dividend of $1.20 last year, and if your required rate of return is 14%, what is the maximum price that you'd be willing to pay for this company's stock? So basically, what you want to do is chart out the rest of the years at 14%. The initial is 120, the dividends, and the growth is 6%. And then your required rate of return is 14%. So you plug that into the equation, and that'll give you the $1.27. You divide that by the rate of return minus the growth, which gives you the max price of $15.88. And then the other one is Clarion Corporation has been selling electrical supplies for the past 20 years. The company's product line has changed very little in the past 5 years, and the company's management does not expect to add any new items in the foreseeable future. So they're asking what is the current value of this company's stock. If they paid a dividend of $4.45 last year to its common stockholders, and it's not expected to increase its dividends for the next several years, so the growth rate is 0%. So since the dividends are not expected to grow, you can go the d to the 1, 2, all the way to the infinity can be 445, and it would just be 445 divided by the rate of return, which is 13%, for a total of $34.23. That's the current value.
Alright, so I did problem 8.1 and problem 8.2. So in 8.1, it wants us to calculate the price of a 5-year bond that has a coupon of 6.5% that's paid annually, and the current market rate is 5.75%. And so basically, in order to find the price of the bond, I wrote the equations down. C1 divided by 1 plus the interest, the percentage, and then that's what the first one. The second one is the same thing, except you square it, then to the third power, then to the fourth power. And this one's to the fifth power, except you add it to the, in this case it's $1,000. And then do all the calculations, and then at the very end you find out that the price of the bond is $1,031.81. And here you just add them all up. And then for 8.2, it's a very similar problem. It's another 5-year bond, but it was purchased 1 year ago at an 8% coupon. It's compounded semi-annually, and the yield of maturity is 9%. Same thing, find the price of the bond. It's a really, really long equation, so I only wrote down about half of it. Go 40 over 1 plus, and then it's the interest. And then do all the calculations. It comes out to be really long, and you get $967.02. Alright, so my first problem was 8.1, and pretty much a corporation is issuing a 10-year bond with a coupon rate of 8%, and the interest rate for similar bonds is currently 6%. And what we're trying to find is what is the value of the bond. So you have a maturity of 10, coupon rate of 8%, and to find the annual coupon you do 1,000 times 8%, which gives you $80. And then your current market rate is 6%, and so then you have this equation, which is the present value of the bond, and you do that times the coupon, or the annual coupon, and then 1 minus 1 over 1 plus the interest rate to the nth power, over the interest rate, plus the future value over 1 plus the interest rate to the nth power. And so when you plug in all these numbers, you get 588.81 plus 588.39, and that gives you your value of the bond, which sits at $1,147.20. And then for 8.5, have a corporation that has a 5-year bond whose yield to maturity is 6.5%. The bond has no coupon payments, and we're trying to find what is the price of the 0 coupon bond. So you have your yield to maturity is 6.5% with no coupon payments. So you do your maturity times the years, which is 5 times 2, which equals 10. And your interest over 2, you can see that. And then that gives you 0.0325. So this is all the given information, and you're trying to find the present value of the bond, which equals the future over the 1 plus the interest rate to the m to the nth power. And that gives you $1,000 over 1.0325 to the 10th power. And that gives you a final answer of $726.27.
Slide 9.29 and 9.3. And for 9.29, it says Tintin Waste Management Incorporated is growing rapidly. Dividends are expected to grow at a rate of 30%, 35%, 25%, 18% over the next 4 years. Thereafter, management expects dividends to grow at a constant rate of 7%. The stock is currently selling at $47.85, and the required rate of return is 16%. Compute the dividend for the current year, D0. So you're going to do D of 47.85 equals D of 0 times 1.12 plus 1.13 plus 1.14 plus 1.43 plus 17. When you do that, you're going to get $47 or 47.85 over 22.26. And if you divide those two, equals 215. So that's your answer. And then for 9.3, it says equation 9.4 shows a relation between the stock's value and the dividend that is expected next year. If dividends grow at a constant rate forever, if a firm pays all of its earnings as dividends, show how equation 9.4 can be rearranged to calculate that firm's P over E ratio. What does this tell us about the factors that determine a firm's P over E ratio? You can do P0 equals D1 over R minus G equals E1 over R minus G, where E1 is the earnings per share next year. And then if you rearrange it, it's P0 over E1 equals 1 over R minus G. And this formula tells us that the P over E ratio is determined by both the risk of the dividend cash flows and the rate at which they're expected to grow.
Who's presenting this? Who's doing their chapter presentation?
But there's another, where's it?
Should be 5 and then 7, but when there are people on here, but.
That's cool. Yeah, it's show must go on.
Show must go on.
Show must go on. So I would just go ahead and do it. Are you guys ready to go first? Okay. Thank you. But you got
Is there a form that actually no. Oh,
Yeah, I would probably just pull it up on here. We just logged in.
Just trying to figure out.
Yeah, where's the remote?
Can you turn it on? Stop. Yeah.
Alright, so today we're gonna be. Okay, so today we're gonna be talking about the fundamentals of corporate finance, or more specifically Chapter 7 for risk and return. And the learning objectives are to explain the relation between risk and return, describe the two components of a total holding period return, and calculate the return for an asset. Explain what an expected return is and calculate the expected return for an asset. And to explain what the standard deviation of returns is and why it's important in finance and to calculate it for an asset. And to explain arithmetic average return and geometric return and calculate these returns for an asset, explain the concept of diversification, discuss what type of risk matters to investors and why, and lastly to describe what the capital asset pricing model tells us and how to use it to evaluate whether the expected return of an asset is sufficient to compensate for an investor for the risks associated with it. So the risk and the rate of return is the rate of return that investors require for an investment depends on the risk associated with that investment. The greater the risk, the larger the return investors require as compensation for bearing that risk. The rate of return is what you earn on an investment, stated in percentage terms. The risk is a measure of how certain you are that you will receive a particular return. So the greater the risk that's associated with investment, the greater the return the investors expect. Investors want the highest return for a given level of risk or the lowest risk for a given level of return. And the quantitative measures of returns, the total holding period return consists of capital appreciation and income. So as you can see, it's the return of the capital depreciation or the return of capital appreciation is equal to capital appreciation over initial price, and the return of income is equal to cash flow over initial price, and then the total holding period return would be equal to both of those added together, both the return of capital appreciation and the return of initial price. So an example problem would be Ella buys a stock for $26. After 1 year, the stock price is $29.90, and she receives a dividend of 80 cents. What is her return for the period? And so you plug in all the values into the equation, and you eventually get 18.08%. The expected return is the weighted average of possible investment returns, also known as the sum of each possible return multiplied by the probability that it will occur. And so an example of this would be there's a 30% chance that the total return on stock will be negative 3.45%, a 30% chance it will be positive 5.17%, a 30% chance it will be 12.07%, and a 10% chance it will be 24.14%. Calculate the expected return for the stock. And so you plug all the values into the equation, and you get 6.55%. multiply each square difference by its probability of sum. Yeah. And then calculate the standard deviation by taking the square root of the variance. And then this is just an example. The normal distribution is symmetric, and the mean and standard deviation are the only information we need to determine the shape. The mean average is the center and the reference point to which all the other values of the distribution are compared. Values less than the mean are on the left, and values greater than the mean are on the right. The left and right sides are mirror images. To use standard deviation as a distance measure, consider how many standard deviations are between the value of the distribution and the mean. Standard deviation tells us, based on what has happened in the past, the probability that any outcome will occur. Standard deviation can be used in the context such as the average return on the S&P 500 is 30%. What is the probability of it being between 3% and 1%? When the difference between 3% and 1% is converted to standard deviation because of distance. Outcomes that occur most often are closest to the mean. Outcomes that occur most often are closest to the mean convert to fewer standard deviations. Outcomes that rarely occur are farthest from the mean and convert to more standard deviations. For a normal distribution, standard deviation is associated with the probability that an outcome occurs within a certain distance from the mean. 90% of the outcomes are within 1.645 standard deviations of the mean. 95% of the outcomes are within that 1.960 standard deviations of the mean. And 99% of outcomes are within 2.575 standard deviations of the mean.
So this is just an example of what a normal distribution looks like. It's a standard bell curve. More examples. So the historical market performance. On average, annual returns have been higher for riskier securities. On our exhibit, which was in the previous slide, it shows that small stocks have the largest standard deviation returns and the largest average return. On the other end of the spectrum, treasury bills have the smaller standard deviation and the smallest average return. This might be because they're risk-free through the government. So the arithmetic and geometric average returns, we had to do this in our pre-test, so we should all know this, but the arithmetic average return is the return earned in the average period. The geometric average return is the average compounded return earned by an investor. So that's our equation, but for investing in two or more assets, these returns do not always move in the same direction at the same time. Investors can reduce the risk in their investment portfolios. I think we all know what a portfolio is, and that you want to diversify your portfolio so you don't put all your eggs in one basket and risk losing a lot of money. The coefficient of variation, also in our pretest, returns for individual stocks are largely independent of each other and approximately normally distributed. Simple tools for comparing risk and return for individual stocks, the coefficient of variation. Is right there. The Sharpe Ratio. So this is a modified version of the coefficient of variation. It measures the return per unit of risk. So the expected return of a portfolio. The coefficient of variation and the Sharpe Ratio have a critical shortcoming when applied to a portfolio of assets. They cannot account for the interaction of asset risks when they're grouped into a portfolio. This is a question. This is just an example. We don't need to go over. And then continued with risk and diversification. So the risk for a portfolio of two stocks is less than the average of the risks associated with the individual stocks. When stock prices move in opposite directions, the price change of one stock offsets some of the price change of another stock. So that's why we want to diversify. And again, covariance, this is also in a pretest. So this indicates whether stocks' returns tend to move in the same direction at the same time. If it does, then the covariance is positive. If not, it's either negative or zero. That's the equation.
Okay. So to measure the strength of the covariance relationship, divide the covariance by the product of the standard deviations of the asset returns. This result is the correlation coefficient that measures the strength of the relationship between the assets returns. That's the equation. And the correlation coefficient cannot be greater than 1 or less than -1. Negative correlation indicates that asset prices moved in opposite direction. Positive correlation indicates that asset prices move in the same direction. Zero correlation indicates that there's no linear relationship between the return on assets. If assets are not perfectly correlated, risk can be reduced by creating a portfolio using assets having different risk characteristics. Limits of diversification benefits when the number of assets in the portfolio are large, adding another stock has almost no effort on the same deviation. Most risk reduction from diversification may be achieved with 15 to 20 assets. Diversification can virtually eliminate risk in each individual. Firm-specific risk relevant to a particular firm can be diversified away, called unsystematic or diversifiable risk. Risk that cannot be diversified away is non-diversifiable or systematic risk. This is the risk inherent in the market or economy. Firm-specific risk is, in effect, reduced to zero if diversified in the portfolio, but some systematic risk remains. And these are just some examples of diagrams. So investors do not like risk and will not bear risk if they can avoid by diversification. While diversified portfolios contain only systematic risk. Portfolios that are not well diversified face systematic risk plus unsystematic risk. No one compensates investors for bearing unsystematic risk, and investors will not accept risk that they are not paid to take. Systematic risk cannot be eliminated by diversification. Competition among diversified investors will drive prices of the assets to the point where the expected returns will compensate investors for only the systematic risk. These are some diagrams.
So we want to measure the systematic risk. So the average return of all the assets is used as a benchmark, and its influence on the return for a specific stock can be quantified. The expected return on that stock can actually be calculated. So the market's influence on the stock's return is quantified in the stock's beta. The beta of an asset is, so 0, the asset has no measurable systematic risk, or greater than 1, the systematic risk for the asset is greater than the average for assets in the market. Moving on to risk premium. So the risk premium is the difference between the market rate of return and the risk-free rate of return. The difference between the required return on a risky asset, which is represented as R_I, and the return on a risk-free asset, R_RF, is an investor's compensation for risk. So the expected return on an investment is a function of the risk-free rate, the beta, and the risk premium, as we can see here in this equation, where this is the risk premium. So the capital asset pricing model, this describes the relationship between the risk and required return for an asset. So the graph of the capital asset pricing model equation is known as the security market line, also denoted as SML. The SML illustrates the capital asset pricing model's prediction for the required expected total return for the various values of beta. The expected total return depends on the asset's current price. So if the expected return is greater than the required return estimated with the capital asset pricing model, the expected return will plot above the line, and the asset is considered to be underpriced. This is an example of the capital asset pricing model and we saw, if you want to go back one, this line here is this SML security market line. So the capital asset pricing model and portfolio returns. There's expected returns for a portfolio is the weighted average of the expected returns of the asset in the portfolio. The beta of a portfolio is the weighted average of the betas of the asset in the portfolio. So we can see that here represented in this equation. An example using beta would be that. That's in our homework, I believe. You can keep going. Is that it?
Yeah.
Oh, I thought we had one more. Okay, well apparently we don't have our last 2 slides, but that's fine. That was chapter 7.
Anybody else? Is that it? You guys good?
We can, or we cannot. It's up to you.
No.
That's a you go. Here we go. All right. Let's go, bro. Brian.
You can do it. How much time do we have?
It is 12:35.
30 minutes? How long do you think it'll take to do your presentation?
What's up?
How long do you think it'll take?
We only have 29 slides, so I don't.
Because I wanted to spend like 5-10 minutes at the end.
Move.
Yeah. I mean, we all, you know, we all think, but we're all thinks and we're-
Something like that.
Something.
Is it okay if we present it like this? Just 'cause-
Yeah, I can understand that.
Alright, so we did chapter 8, bond valuation and the structure of interest rates. So the learning objectives is to describe the market for corporate bonds and 3 types of corporate bonds. We want to explain how to calculate the value of a bond and why bond prices vary negatively with interest rate movements. We want to distinguish between a bond's coupon rate, yield to maturity, and effective annual yield. We also want to explain why investors in bonds are subject to interest rate risk and why it is important to understand the bond theorems. 5, to discuss the concept of default risk and how to compute a default risk premium. And 6, to describe the factors that determine the level and shape of the yield curve. So, market for corporate bonds. The value of corporate bonds in the US was about $9.7 trillion in 2016. The most important investors are life insurance companies, pension funds, and mutual funds, and transactions tend to be in very large dollar amounts. Also, there's only a small fraction of the bonds outstanding are traded each day. Most of them take place through dealers in the OTC market, and the market is thin compared to markets for money market securities and stocks, so corporate bonds are less marketable than securities with large daily volumes. Prices in the market tend to be more volatile than those of securities with greater trading volumes. Alright, so the types of corporate bonds, there's a fixed income security, and those ones pay interest in fixed amounts for the life of the contract. Some features of them are they are long-term claims against company assets. The face or the par value of it is $1,000. The coupon rate is the annual payment divided by the bond's face value. And the coupon payment is a fixed amount paid to lenders for the life of the contract, so it's usually semi-annually or annually. And then more types of corporate bonds. There's vanilla bonds, also called a debenture, are typically unsecured. The coupon payment's fixed for the life of the bond. It's repay principal and retire the bonds at maturity. Contracts have the features and provisions found in most bond covenants, and they are annual or semi-annual coupon payments. There's also the zero coupon bond, which has no coupon payments. It pays a face value at the maturity, and you sell it at a deep discount. And there's also the convertible bonds, which may be exchanged for shares of the firm's stock. You could sell it for a higher price than a comparable non-convertible bond, and the bondholders benefit if the market value of the company's stock gets high enough. Bond valuation. To calculate the bond price, you determine the I, or the required rate of return, and expected future cash flows. So that's just the equation, PV equals PV plus the coupon payments plus the par value. Alright.
and then that's just the cash flow for 3-year bonds, kind of the problem that I did earlier. Yeah, alright, we'll keep going. The par premium and discount bonds. The par bond is if a bond's coupon rate is equal to its yield, the price will equal the face value. A discount bond, if a bond's coupon rate is less than its yield, the price will be less than the face value, which is also likely to happen when interest rates are rising. Premium bond is if a bond's rate is more than its yield, the price will be higher than the face value. And that's more likely to happen when interest rates are falling. Semi-annual compounding. Most bonds issued in Europe pay annual coupons, but bonds issued in the US usually pay semi-annually. And then there's this long equation.
You just gotta remember that you divide the coupon by the,
Maturity.
it's semi-annual.
Yeah. Yeah, the I divided by the M.
Yeah, it's the C divided by M and I divided by M.
Yeah. The zero coupon bonds, they pay the face value at maturity, but they do not make coupon payments. The yield of a coupon, the zero coupon bond is therefore the present value of the par value, and zero coupon bonds pay cash only at maturity. They sell for less than similar bonds. And then there's the equation. And then yield of maturity, or YTM, is the rate that makes the present value of the bond's cash flows equal to the price of the bond. And YTM changes daily as interest rates change. The effective annual yield, or in bond trading, the effective annual rate, the EAR, is called the effective annual yield, EAY. And then here's the equation to get EAY. 1 plus the quoted interest rate over M to the M power minus 1. And the simple annual yield is yield per period multiplied by the number of compounding periods. And then since if it's annual compounding, and then if it's semi-annually. And then bond yields, the realized yield is the return earned on a bond given the cash flows actually received by the investor. And the realized yield is important because it allows investors to see what they actually earned on their investments.
This is just like an example based on that realized yield. So interest rate risks are uncertainty about future bond. Speak up. Uncertainty about future bond values due to the unpredictability of interest rates, which would be like kind of right now. These interest rates are going down. Bond theorems are statements about the math used in bond pricing. So bond prices are inversely related to interest rate movements. As interest rate declines, bond prices rise, and as interest rates rise, bond prices decline. For a given change in interest rates, prices on longer-term bonds change more than the prices of short-term bonds. So interest rate risk increases as maturity increases, but at a decreasing stage. For a given change in interest rates, prices of lower coupon bonds change for more than prices of higher coupon bonds. This is just an example of like the graph of how it works. Yield curve. And then this is the kind of the relation example. And then back on it. Bond theorem applications. If the interest rates are expected to increase, you should avoid long-term bonds because of the changing volatility. These will experience the largest price declines. And if interest rates are expected to decrease, buy zero coupon bonds because they just pay all at the end. They don't pay on the interest rates. And then the structure of interest rates. 4 features of debt instruments are responsible for most of the differences in corporate borrowing costs and determine the level and structure of interest rates. So there's marketability, call provision, default risk, and term to maturity. So marketability is how quickly and easily a security can be sold at a low transaction cost and at a fair market value. So the selling price varies directly with the degree of marketability, the transaction cost varies inversely, and the yield to maturity rate is inversely with the marketability. Basically, it's how easy it is to get and sell. And the difference in yields between a highly marketable security and a less marketable security is the marketability risk premium, which equals the interest rate on the high market minus the interest rate on the low market bond. It's greater than 0. And U.S. Treasury bills are considered the most marketable of all securities. Call provision. The call provision is the bond issuer's option to purchase a bond from the bondholder at a predetermined price before maturity. So when bonds are called, bondholders suffer financial loss because they must surrender higher yield bonds and replace them with lower yield bonds because they haven't gotten all the way to full maturity. Callable bonds sell for lower prices and higher yields than non-callable bonds to compensate the buyer for the risk when the bond is called, because if you want to sit on the bond and make more money, there's a chance they should call it back. And bonds paying high yields are more likely to be called when interest rates decline. The difference in interest rates between between a callable bond and a non-callable bond is the call premium. And then the CIP is the interest rate of the callable minus the interest rate of the non-callable, interest rate of 0. The default risk is the risk that a borrower may not make payments as promised. So lenders are paid default risk premium for purchasing securities with default risk. The default risk premium is the difference between the yield on a security with default risk and the risk-free rate. So that equals the interest rate of the default risk minus the interest rate of the risk-free rate. And then the yield on U.S. Treasury bills is a proxy for the risk-free rate, since U.S. T-bills are considered to be free of default risk. And then bond ratings. Individuals and small businesses rely on outside agencies for information on the default potential of bonds. The two most prominent credit rating agencies are Moody's Investors Service and Standard & Poor's, or S&P. So both services rank bonds in order of probability of default and publish rating as letter grades. The highest grade bonds have the lowest default risk and are rated AAA or AAA capitalized. Investment grade bonds are rated AAA to B AA. And then state and federal laws typically require commercial banks, insurance companies, pension funds, certain other financial companies, and government agencies to purchase only investment grade securities. So this is kind of like a list of the security credit ratings. So you can see that they have lower yields but better default risk ratings. The term structure of interest rates overview. The term structure of interest rates refers to the relationship between yield to maturity and term to maturity on a bond. The graph of the term structure of interest rates is a yield curve. The shape and position of the yield curve are not constant. We've seen the yield curves a couple times in this class. As the overall level of interest rates change, the yield curve shifts up and down and changes its shape and slope. So the basic shapes of the yield curve are ascending, or normal yield curve, which is when it goes up for a longer maturity time. Descending, or inverted, which is the sign of a recession, when lower, shorter term interest is higher. And then flat yield curves, which implies that there's no change in the rate over time. So these are just an example of them. We've seen them. And then the factors that shape it are the real rate of interest. This is like the Fisher equation almost. So the real rate of interest changes with the business cycle. The highest rates occur at the end of economic expansion, and the lowest rates are at the end of economic contraction. Changes in the expected future real rate of interest can affect the slope of the yield curve. And an expected rate of inflation, which is what's shifting the yield curve right now to be inverted. It shifted it to be inverted about 2 years ago. So if higher inflation is forecasted, the yield curve will slope upward because longer term yields will contain a larger inflation premium than shorter term yields. And if investors believe inflation will subside, the yield curve will slope downwards. And then there's interest rate risk. The longer the maturity of a security, the greater its interest rate risk. There's selling a security at a lower price, and the higher the YTM. The interest rate risk premium adds upward bias to the slope of the yield curve. So the effects of the structure of the interest rates. The cumulative effects of factors that shape the yield curve is in an economic expansion, the real rate of interest and inflation premium increase monotonically. Interest rate risk increases, and then in an economic contraction, the real rate of interest and inflation premium decrease monotonically, and then the interest rate decreases. That's it.
Perfect. Yeah, that's perfect. Thanks, you guys. Okay, can you pull out your blue books? For the exam, I'll go over the supply demand analysis for the major asset classes. You've already gone through some of it. I think we left off on oil, didn't we?
Yeah,
Yeah. I'm going to do a little review. This applies right to your MAHs. So basically what we're doing is we're laying out the supply-demand analyses that you would go through to be able to identify the factors that are affecting the asset prices. Where's the stock market right now? What?
It's up there.
Who's getting almost 1,000?
It's down. It's over 1,000 now. It's almost
Sorry.
1,200.
You lied to me?
I thought it was up this morning.
Maybe. When I was looking, it was down like 800, it's another 1,000.
It's at 1,200.
So again, going through these gives you, when you're reading the articles, you know, on the major asset classes, it's going to tell you the factors that are affecting the prices. Some days, certain factors, you know, are considered more. Next day, it's maybe something else. Maybe it's interest rates one day, maybe it's credit default, you know, on these bonds. It's, you know, affecting the market the next day. Maybe it's, right now it's all COVID-19, right? It's all, they just revised the expectations of economic growth in China. The manufacturing index just came out this morning. It went from like 60%, which means anything over 50 means that the manufacturing sector is expanding. It's now at like 42, which is the historic low, which means that the Chinese economy is contracting. So everybody's revising down their forecasts for economic growth in China. China tries to target economic growth between 7 and 8%. It's been slowing to 7% over the last few years. They're now forecasting it to grow at 4%, and the numbers that came out today are saying a contraction of 4 to 6%, a contraction. So this will be the first time that China, the third largest economy in the world, has fallen into a severe recession. That's a big freaking deal. And it'll probably pull us down too, okay? So what are the factors? So I'm gonna go through stocks, oil, gold. Again, when you set up a problem, you wanna set up a supply-demand analysis. So the first thing you do is you set up the two graphs. You set up the supply on the top, demand on the bottom. Then you do the demand curve, the supply curve, demand curve, supply curve. They connect equilibrium points between the two graphs. You got the price equilibrium under supply, and you got price and equilibrium between supply and demand, and that's the equilibrium quantity of supply. Down here, it's the equilibrium quantity of demand. Okay, so they're two different things. You got to remember when you're doing supply-demand analysis on supply shocks, it's the quantity supplied. When you're doing the supply-demand analysis under demand, and you're shocking the demand side, it's the quantity demanded. Okay, so there's two shocks to the market: a contraction in supply, so a negative supply shock, and a positive supply shock. A positive demand shock, a negative demand shock. So what are the factors that would cause the supply curve to shift back for stocks? We already talked about this. Would be stock buybacks and reverse stock splits. This is very rare, so the major influences is stock buybacks. You'll probably see a lot of stock buybacks because the 10-year treasury has now dropped below 1%, which makes it extremely cheap to issue bonds in the marketplace. If the companies have room on their balance sheet to lever up, and you'll probably see a lot of bonded issuance and a bunch of stock buybacks to try to prop up their stock prices through financial engineering. What would cause the supply curve to shift out for stocks and cause quantity supplied to shift out and the price to drop? Initial public offerings and seasoned and secondary offerings. These are companies that are already have stocks traded in the marketplace, so they're just issuing more. And then these are the companies that are issuing stock for the first time. Okay. What would cause the demand curve for stocks to go up? Higher population growth, higher labor productivity, which creates higher corporate profits, higher earnings per share expectations, higher production or GDP growth rates, higher employment or lower unemployment, and in both cases they drive wage growth, and then lower interest rates. And as we know, that if you use the Gordon growth model, or what's called the constant growth model, it's future cash flows, CFO T+1, divided by I minus G. I is your expected return, which has the risk-free rate in it. So as interest rates go down, the value goes up for the stocks, holding G constant. Okay. So what would cause the demand for stocks to go down and the quantity demanded to fall? Quantity demanded to fall and stock prices to go down. You just flip it. Lower population growth, lower productivity and profits, lower earnings per share expectations, lower production or GDP levels, and lower employment or higher unemployment, which results in lower wages and lower wage growth, and rising and high interest rates. Okay, so you guys probably want to take a picture of this. This is kind of how I'd like to see it laid out, on the exam. The second are oil prices. What drives oil prices? Same thing, negative supply shock, positive supply shock. Positive demand shock, negative demand shock. So it's the same thing, you're just swapping out with the asset classes. So the only thing I could think of that would cause the supply curve to shift back for oil would be OPEC. OPEC is the cartel, it's the oligopoly. They're coordinate and they cut back production to shift the supply curve back and cause prices to go up. Right now, they're debating because oil prices are falling quickly. They're at about 52 right now. They're forecasting prices to go to 33. And if we go into a deep recession, some people are saying that we could see oil prices back down to 22, which we haven't seen since like the 80s, maybe the 80s, 70s and 80s. What would cause the supply curve to shift out? OPEC production hikes. Actually, right now, the production cuts because of the recession. Russia and Saudi Arabia are negotiating because they're part of OPEC, and they're both all negotiating to cut back so they can prop up prices. But OPEC is known for people cheating in the system. They'll say, okay, we'll cut back, and then when the Saudis cut back and prop up the prices, they flood the market to capture the monopoly profits. So, to shift out the supply curve, OPEC production hikes. U.S. production, offshoring off the coast of California. If we put more wells, that's more production, and fracking has actually introduced more oil that the U.S. can even consume, so they started exporting fracked oil about 3 years ago for the first time in history. And then some people were saying that the cuts in production could also be due to tariffs on Russia, because I think we have sanctions on Russia still, so we're not importing their oil, but Europe is. So that could be another reason why the supply curve could shift back. What would cause the demand curve for oil to shift up? Well, higher global demand or higher GDP. It used to come mainly from China, but now that China's careening, that's not going to be the case. And then higher population and employment growth rates. As there's more people, we consume more oil. As there's more employment due to production, we consume more oil. So in both of those cases, it would shift out the demand curve. What would cause the demand curve to shift down? Again, I just reversed these things. Lower global demand, GDP, lower population employment growth, and the introduction of substitution effect, actually, by the introduction of alternative renewable energy and the adoption of electric cars, on a global basis. Would also have a negative demand shock on oil. How am I doing on time? 5 minutes. Perfect. The next is gold. What would cause the supply curve to shift back? Gold hoarding. We're seeing it by individuals and governments. Different cultures hoard gold, and different governments hoard gold as reserves, gold reserves. What would cause the supply curve to shift out? Well, selling of gold by individuals and governments. Detection and extraction technology to be able to not only identify the gold, but extract it and process it more efficiently. So it's a technological effect, production effect. What would cause the demand for gold to shift down? Low interest rates. What would cause the demand curve for gold to shift up? Higher demand, higher prices. Low interest rates. So if interest rates are low, why would I hold bonds? I can hold gold. As interest rates go up and bonds start to provide me with a higher yield, then I'm going to dump my gold and I'm going to buy bonds. So higher demand for gold would come from low interest rates, geopolitical risk, fear, COVID-19. Actually, the COVID-19 was actually pushing up demand for gold, causing gold prices to go up. And then over the last few days, gold prices started to go down because people were scared of disinflation and deflation. Okay. And so counteracting effects. Higher demand for gold as an inflation hedge because it's highly correlated to inflation. And people buy gold for to hedge against depreciation and devaluation in currencies and the purchasing power associated with the devaluation of those currencies. What would cause the demand for gold to shift down and prices to go down? You just flip it. Lower geopolitical risk, peace in the world, appreciation and revaluation of currencies, both the US dollar and foreign currencies, disinflation and deflation, less incentive to hold gold, and then lastly, high and rising interest rates will also cause the gold demand to shift down. Okay, that's all I got. And we'll do bonds and US dollar